Let's take a brief minute to go back in time to the 1920s. With so many novel inventions like telephones, automobiles and radios, it was a thrilling period to be alive. The financial markets were on the rise at the same time. Like today's IT gigantic companies, American Telephone and Telecommunications was one of the biggest businesses. Everyone desired to try making purchases of stocks since it had become so simple. There were also loans available for capital investment with only a down payment needed. Stock prices increased as an outcome of the substantial number of transactions. Investors thought that period was lovely. However, why does this old tale still apply to us now? This is because investment lessons learned in the past are still relevant today. Now let's explore what these previous lessons may teach us to assist us make wise financial selections in the future. Take a fascinating trip through time to learn about the interesting history of investments from 1915 to the present. The history of the stock market. Imagine this. In 1915, there weren't many alternatives available to those with additional money. The most popular choice, depositing money to receive interest from a bank. It seems easy, doesn't it? The fact is that banks weren't always the best options back then. People may lose their money if they fail, which happens from time to time. And what do you know? Until 1933, there wasn't any protection system like the FDIC, which safeguards the cash you have in the bank. Let's go back to the present day. Investing has advanced significantly. You may rest easily knowing that your money is quite safe if you deposit it with the bank right away. Your bank account is guaranteed up to $250,000, courtesy of the FDIC. This means that your money is safe even if the bank has issues. The problem is that, even while the funds are accessible and protected, they won't increase significantly. These days, banks only give modest returns on your money. That concludes our brief historical overview of investing from 1915 to the present. It is a tale of how we moved from unsafe bank deposits to extremely safe, but slowly increasing savings. And that's something that modern, wise investors need to be aware of. Examine briefly the evolution of investing from 1915 to the present. Investing in business bonds was one way back in 1915 to make a greater profit than banks would give you. Most of these were from utility and railroad corporations. However, it was dangerous since there was no regulations, which mean you may not receive your money back. Furthermore, before 1917, when they were required to finance World War I, there were no federal bonds. Today, bond investors face a very different situation. You have an abundance of options. Some bonds are issued by corporations, states, municipal governments, and even ones secured by real estate, such as mortgages. Additionally, you may invest in bond investments, which include many bond categories if you don't want to choose just one. It has also been a very different stock market. Only 12 businesses, largely in the industrial sector, were listed on Dow Jones in 1915. There are now 30 firms from a variety of industries on the Dow. More opportunities for firms to expand and generate revenue results from this, and investors like you may share in their success. Investing has opened up in the past century. It's no longer reserved for the wealthy. Practically everyone can do it. The majority of assets may now be easily bought and sold electronically, as opposed to holding tactical items that are difficult to sell. The investment industry has expanded significantly, and it's exciting to be a part of it. Let's look at several fascinating historical events that can surprise you. After World War II. After World War II, a remarkable thing happened for investors. It was not dividends, the money that corporations pay you for holding their stocks, that caused them to start generating greater revenues from their stocks. Capital gains, or the profit you receive from selling stocks for more than you paid for them, was the main focus. And guess what? When you consider inflation, these benefits are much more impressive. What caused capital gains to rise after 1950? There were two major events. Initially, nations like Japan saw extremely rapid growth, which attracted large sums of money from investors. Second, the 1950s saw an improvement in global economic stability, and the 1980s and 1990s saw a decline in inflation. This was ideal for increasing stock profits. Compared to the hard days of the 1910, 1930s, and 1940s, it was a complete contrast. Dividends have been neglected. dividends began to decline as capital gains did. Why? A lot of large corruptions, particularly in the technology sector, have chosen not to pay dividends in favor of using their funds to expand. In addition, many individuals began investing for their future rather than only for present-day income. Furthermore, taxes in countries such as the US often favor capital gains from the sale of stocks over dividend payments. Additionally, businesses began repurchasing their stock rather than disbursing dividends. The 1950s. An important shift in history between 1914 and 1949. There were many difficult times, 2 world wars, a severe economic downturn, you name it. However, an era of tremendous expansion began in the 1950s. Except for the 1970s, much of the second half of the 20th century was excellent for profiting from stocks. A challenging period for investors in fixed income. An increase in inflation and interest rates after 1950 made life difficult for investors in bonds and other investments. They had to endure a protracted 40 years era of hardship. However, they saw a far better period from the 1980s to 2000 as both inflation and interest rates decreased. The future is not predicted by past performance. This is a crucial point to remember. Just because investments perform successfully in the past does not guarantee that they will again. Our analysis on bonds, bills, and equities reveals that economic ups and downs frequently coincide. A decade's worth of labor may not translate into the next. Financial markets are just that way, and they probably always will be. That's it, a century of highs and lows in the world of investment, summarized for you. Recall that the great thing about the world of investment is that it's always evolving. Lessons for the 21st century investor. Let's explore some essential investment advice for the 21st century easily. Bonds usually lose ground to stocks over time. Treat investing like a race. In a protracted contest, stocks tend to prevail over bonds. This is a result of dividends, which are additional payments made by businesses to their shareholders. Over time, these dividends may accumulate and improve stock performance. However, over time, the difference between the additional money you receive from dividends and the profit you gain from rising stock prices has decreased. The ups and downs of investing in stocks. Stock investing could feel like a roller coaster. The equity risk premium is the amount of money you may occasionally get paid for taking a risk, although it varies greatly. This price has fluctuated in the past. At times, it was unfavorable, and at other times, it was outstanding. Bonds are more based on expectations for inflation and price movements than stocks, which are based on expectations for corporate profits in the future. For instance, bond investors did not fare well during the 1940s to 1980s interest rate increase. But when interest rates fell between 1980s to 2000, they had a golden period. Different times, different results. The additional advantage of investing in stocks rather than bonds has changed throughout time and across different countries. The amount awarded was lower in the US, UK, and Australia from 1925 and 1949 when inflation was low. However, it was greater in nations with strong rates of inflation like France, Germany, Italy, and Japan. Tips to invest in your 20s. Since investing might be unpredictable, it's critical to comprehend how circumstances could shift. Selecting stocks or bonds is not enough. You also need to understand the path that they might put you on. Investors should anticipate a smaller stock premium if they predict future deflation or reduced inflation. When interest rates and inflation rise over the 3 to 4% range, that is considered typical. To get you started strong, I have some very awesome advice. Recall that life is a journey, and you can follow your investing strategy through all of its ups and downs. Let's examine it. Start with a plan. Consider this as a roadmap for your finances. It is only a guide to help you move closer to your goals, so it does not need to be perfect. Planning will help you determine how much you put away and spend each month. Whether your goal is to save for a dream vacation or a comfortable house, deal with that debt. if you're in the same boat as many young adults, you may be concerned about your student loans. Take a look at a pro tip. Focus on clearing your debt first. It's similar to preparing the runway for a financial landing. Savings for retirement. Now is the time. I realize that retirement feels so far off. It's like sprouting a seed that develops into a money tree. Though if you start saving early, it's also a fantastic habit to form at a young age. Don't miss out on free money. Accept the 401k match if your employer gives one. It's similar to receiving a bonus from making future savings. Maintain simplicity. I assume you have packed life, therefore make basic investments. Investing in index funds allows you to diversify your portfolio without having to deal with the stress of choosing particular stocks. Ignore the hype. Although meme stocks and cryptocurrencies are quite popular, they are dangerous and exhilarating, similar to roller coaster in an investing world. Prioritize building a strong foundation before, if you like, allocating some fun money for those exhilarating rides. Ask for help. It's okay to ask for financial guidance. Speak with a financial expert or a wise relative. It functions similar to a GPS on your financial path. Investing in your 20s, it's all about laying the groundwork for a brighter tomorrow. Every action you do today contributes to the realization of your long-term goals. So prepare yourself and let's see how your money serves you. Conclusion. And that concludes our little tour of investment history. We observed a lot of changes from the 1920s to the present. There are now plenty of options for investors, but in the past, it was riskier and more restrictive. Young adults have a lot to gain from all their past stories for their financial planning. Always start small, wipe off debt, put money down for potential goals like retirement, and handle your assets with ease. Never forget to avoid risky trends. Make use of any free money from the company's 401k match. And don't be hesitant to ask for financial counsel when you need it. Even though the investment landscape is always evolving, you now have access to some very good guidance. Using these pointers can help you make prudent financial decisions, lay a strong basis for the future, and see growth in your savings. I encourage you to begin your investment path as you have a bright future ahead of you. I hope you succeed and enjoy using your money to further your goals.